What if I told you 28.6% of business sellers are betting their future on earnouts with an average of $147,000 on the line? And the thing is, they don't understand how powerful it is to say yes to seller financing, yes to earnouts to get a deal done. In today's video, I am going to show you one, why earnouts are becoming a lot more common in this current market and why they often make sense for you to do and when they are an absolutely terrible idea for you to do. And I'm also going to go over how our most successful clients at Empire Flippers treat earnouts, the strategies they use to help them actually get paid. The one really cool thing about earnouts that sellers don't often think about is if you structure it in the right way, you're actually going to get paid a whole lot more money. Let's get into it. First, we need to talk a little bit about definitions here. Earnouts aren't just delayed payments like how seller financing often is. They're performance bets on where the buyer holds most of the power. It is sort of a cousin of seller financing. So in seller financing, the terms are quite clear what you're going to get paid and is usually going to be on this steady repayment schedule, right? Earnouts go the other way, on the other hand. You'll usually do an earnout when there is a buyer and seller valuation gap expectations. Like you're saying the business is worth this much, the buyer is saying it's worth this much. You guys cannot find middle ground, so the buyer uses an earnout to kind of like bridge that gap, right? Often this happens because a seller believes the business is going to keep growing and has high confidence in doing so, and they want to get paid a higher price due to all that extra growth they see on the horizon. Earnouts are kind of a compromise between the buyer incentive and the seller incentive. So the earnout comes in as this tool that hedges the risk for the buyer and still can pay the seller what they want, despite them having this difference in this valuation gap. Our data shows 87% of the deal value, the sales price of the business, typically is paid up front. Now that is across a lot of deals with a lot of different business models, different pricing points, all that kind of stuff. So take that with a bit of a grain of salt. But nearly $40,000 per deal rides on some kind of future performance on average. And that performance is often controlled by the buyer. Now, within that, there is often a mix of not just an earnout, but also seller financing in that 13 to 21% that is not fully paid out to the seller. So the major difference here between seller financing and earnouts is seller financing, steady Eddie, pay as you go, maybe it's on a monthly payment, quarterly payment, or biannual payment, something like that, right? Earnouts, you only get paid. Typically, the most frequent I've seen it is on a quarterly basis. Very rarely is it going to be a monthly payback, and you only get paid that earnout if the business hits certain metrics. So usually it's going to be tied to revenue. Sometimes it's tied to profit, sometimes it's tied to other milestones. So this is one of the primary risk mitigation tools that buyers use when they go and acquire businesses like what you are building. And there's nothing wrong with that. We got to play with where reality is. So some scenarios why buyers might push these earnouts, other than the obvious like risk mitigation stuff I talked about, is one, like let's say you're selling a service business. Often in service businesses, they rely heavily on these key relationships. And those relationships are often associated with the founders of those businesses, which is a big critical point of failure for the buyer, right? Because they're not you. So they might have an earnout related to that is really more of a bridge to make sure the transition of the business actually goes well. Another place I see this quite often is in high complexity businesses. So buyers want proof that this business can truly run without you. High complexity businesses could also be like a personally branded businesses, which also could be a service business, right? A lot of agency owners are the face of their own business. And when they go to sell that agency, that becomes a point of friction between them and the buyer for obvious reasons, right? Another reason why a buyer might do an earnout is competitive bidding. So if you come and sell your business with Empire Flippers, I believe our average NDAs we sign per listing is somewhere around 80 NDAs or something like that. And unlike other brokers, our NDAs actually mean something, because in order for you to sign an NDA to look at a business deeper, you actually have to verify to us that you actually have the financial ability to buy the company. Otherwise, we don't let you look at it. It's not like other brokers where you just sign an NDA loosey-goosey and like, yeah, I'm sure he's qualified to look at this, right? So in those situations where a buyer knows like, hey, there's a lot of other buyers like competing over this business, if they really want the business, they'll probably pay you an earnout that is much more on top of the actual sales price of what you want as a deal sweetener to get you to say yes to them versus other buyers. Let's talk about when earnouts work the best. Like, when should you do these things? So the most successful earnout trades that we've seen across, thousands of deals at this point is when there's clear objective metrics tied to the earnout. Now, in my experience, most earnouts are going to be tied to revenue. Now, the reason why that is because buyers, when you buy a business, they want to reinvest heavily into the business, which is going to lower the profit, even though the revenue is going to stay relatively the same, right? So this gives them some room to breathe to reinvest in the business. Next thing with earnouts is realistic timelines. So like I said, I've seen earnouts on the short end of 6 months all the way to 36 months. As a business gets bigger, so too usually does the timeline of these earnouts. But you want to have quarterly check-ins on these earnouts. That should be part of your deal structure. Maybe you get QuickBooks, like view-only access, something like that, right? To make sure that the buyer is doing as they say and the business is performing as they say. But quarterly checkups, that doesn't seem that unrealistic to me, and it is a good thing to help you keep your buyer on track to make sure you're getting paid and also offer help. And the third thing is kind of what I already hinted at, which is seller involvement. One of the reasons why buyers like earnouts, it gets you involved. It keeps you involved in the success of the business. A buyer likes to see a seller who keeps some skin in the game in some shape or form, outside of the capital mitigation risk stuff. Like, they like to see that the seller is still in it to win it and to help the buyer if they need to. Usually what this comes down to is maybe in the post-acquisition, first 2 months, maybe you have a weekly call that's like an hour long. And then after that, usually it whittles down to maybe a call once a month or an emergency call like, hey, Mr. Seller, where was that software login for this? We can't seem to find it. Do you happen to know? Stuff like that, right? So let's talk about when you should not do this, basically. So most sellers, they focus on total deal value versus the probability of collecting. And this can change things in your mind, right? So a $300,000 offer with $100,000 in earnout isn't automatically better than a $250,000 all cash deal if the earnout is unlikely to be paid. And that's what it really comes down to, is how much do you trust the buyer? And did you structure it to where you can get paid more than the price of the deal so you get rewarded for taking the risk in the first place? The other thing you need to look at is, do they have any experience in the business operations for a business like mine? And again, it's okay if they don't, but that should also go into your calculus on the probability of the success of them paying you out. So look at the track record, look at your relationship with them, and ask yourself, have they ever operated anything remotely similar to what they're buying from me right now? These are the key questions on whether or not earnout is going to get paid. And if they do have a track record, see if you can't talk to their previous sellers that they bought to see how those structures work. That gives you an extra sense of confidence in this buyer actually paying that earnout. So let's talk about how you can protect yourself as a seller if you decide to do an earnout. There's 3 main things I recommend. And the first one that I recommend is conservative targets. You want to make sure your projections are pretty conservative, the things that you and the buyer agree to. Now, one tricky thing you might come into contact with, especially if you're selling a multiple 7-figure business or an 8-figure business, is private equity people who are absolute wizards of finance and spreadsheets. They can cast all the magic spells on them. They might offer you an earnout that looks amazing, but they know that the business is not going to perform up to the standards of the earnout, which means they will have to pay you. So sometimes buyers will use, like super savvy buyers, will use earnouts as a way to additionally mitigate their risk. It's a hidden tax against you as the seller. So that's the first thing, conservative targets. The other thing is multiple milestones. Don't get paid all at once at the very end. You should try to push for quarterly or at least biannual payments so you're getting a little nibble at the full pie every 6 months or every 4 months, right? And this also keeps the buyer on track where they don't forget about you, which is the big problem with things like balloon loans usually, where the buyer gets busy, forgets, oh shit, I got a balloon payment coming up, right? So you don't want that. You want to ideally have multiple milestones, multiple check-in points whenever you're doing an earnout. The third thing that you can do, which has its use but is not always effective, because I'll get into why that is in a second, is penalty clauses. So if the buyer doesn't pay you on time for what he owes you, or if they do something that really hurts the business, say like slash the marketing spend that you told them not to do, or fire this entire department of people to save costs, stuff like that, you can have that as a covenant in your earnout in your deal structure, say, hey, like we need to accelerate this payment, or the earnout is now like different to this because you did that. Now, the reason why that often doesn't work is because if things are going bad in the business, the buyer needs to have leeway to do what they think is best for the business, which might mean cutting that ad spend or cutting that marketing, right? And if things are going bad for the business, yeah, you can add penalties all day long, but that often doesn't mean you're going to get paid, right? But you can use this as kind of like, hey, this is like our red line. Let's not cross that. If we're getting close to that, let's communicate, see how I can help. And like turn this around, right? So everyone has happy days again, right? So how do you decide if you should accept one of these earnouts? Well, the first step is don't reject it immediately, because that's like the knee-jerk reaction for most sellers. Like, no, never. It's too risky, right? Don't say no to it, because by saying yes to it, remember, you're often still getting a huge upfront payment, right? Often 80, 87% of the sales price of your business, you're still getting as cash. And out of the remaining 15 to 20% or so that is going to be financed, not all of that's going to be an earnout either. A lot of that's going to be seller financing, right? So I wouldn't immediately say no to that. The other thing is look at the structure, not at the total number. How do you get to that total number? What are those metrics? What do they need to see to make it feel like, yes, I will pay you that earnout, right? And are those reasonable things, right? And finally, is this buyer trustworthy? Are they reliable in terms of their track record with other acquisitions? And do they have the operational experience to run a business like the one I'm selling? Earnouts in general can be a fantastic tool, both for buyers and sellers. So you as a seller, if you're thinking about selling a business, you get an earnout offer, take a chill pill, think it through, don't immediately reject it. Just by saying yes to earnout, it might just make you millions of dollars. And if you would like to make millions of dollars with a life-changing exit, come and sell your business with Empire Flippers. We've sold over 2,400 businesses, including a $6.5 million agency for full list price in 30 days. Pretty cool, if I must say so myself. So if that's you, if you want to have a life-changing exit, go to empireflippers.com/sell, and I'll see you in the next video.